Here's something most investors never think about. Warren Buffett spends roughly 80% of his working day reading. Not Twitter, not CNBC, not analyst price targets. He reads annual reports, tens of thousands of pages of them over a career. And he has said publicly that the single best place to understand a business is the company's own filings with the SEC. So here is the uncomfortable question. When was the last time you read one? Most investors have a process that goes something like this. Open a chart, check if the stock is up or down, glance at a headline, maybe look at a price target from a bank, and then make a decision. That is not investing. That is guessing with extra steps. The professionals start somewhere different. They start with the business itself. And the single best document for understanding a business is the annual report, the 10K. It is where a company tells you exactly what it does, how it makes money, what it is afraid of, how profitable it really is, how much real cash it generates, and sometimes, if you read carefully, where the cracks are hiding. The reason most people never read it is not laziness. It is intimidation. Hundreds of pages, dense language, accounting tables, legal footnotes. So in this video, we are building an investor's map of the 10K. Not an accounting course, not a forensic audit. A practical system that shows you where to look, what to look for, why it matters, and how to use it to build a genuine investment edge. Because here is the real payoff. When you know how to read a 10K, you stop trading tickers and start buying businesses. That is a completely different and significantly better game to be playing. A 10K is the annual report that every public company in the United States files with the SEC. But here is the critical distinction most investors miss. A 10K is not marketing. It is a legal document. Compare it to what a company puts on its investor relations page. Polished slides, cherry-picked metrics, optimistic language, branded photography. The 10K is the opposite. It is filed under oath. Executives sign off on it personally. Misrepresenting material information is a federal crime. That legal pressure creates something rare in the financial world. A document where companies are forced to tell you things they would rather you did not know. The risks they face. The customer concentrations they carry. The debt obligations they owe. The litigation they are defending. Now, why does this matter more than just watching the stock price? Because in the short term, stock prices are emotional. They move on sentiment, interest rate expectations, market momentum, Twitter narratives, and fear. A stock can drop 20% because a macro hedge fund is selling, even if the underlying business has never been stronger. But over the long term, 3, 5, 10 years, the stock price converges on one thing: the economics of the business. Can it grow revenue sustainably? Can it protect its margins? Can it convert profits into real cash? Can it survive a downturn? Can it reinvest capital at attractive returns? The 10K is where you go to answer those questions systematically, rather than guessing. It does not give you a buy or sell signal. No document does. What it gives you is the raw material for a judgment that most other investors will never make, because they never did the reading. Finding the 10K is simple. There are two main sources. The first is Edgar, the SEC's public database. Go to sec.gov, search for the company, and filter for the filing type 10K. Everything is there, going back decades. The second is the company's own investor relations page. Most public companies have a section called SEC filings, or annual reports. Same document, usually easier to navigate. Now, a 10K does not exist in isolation. It is part of an ecosystem of documents that serious investors read together. The 10K is the annual report. Complete, detailed, filed once a year. This is your foundation. The 10Q is the quarterly report. Shorter, but it tells you what has changed since the annual filing. Think of it as a quarterly update to the thesis. The earnings release gives you the most recent results in a cleaner format, the version designed for fast consumption. The earnings call transcript is where things get interesting. This is where analysts who have read everything ask management the hard questions. Watch for what management emphasizes, what they avoid, and whether their answers are specific or evasive. The investor presentation is the most polished and optimistic version of the story. Useful for context, but treat it like advertising. For this video, we are focusing on the 10K. It is the map of the business, and everything else is commentary on top of that map. Open a 10K for the first time, and it can look like someone handed you a legal contract written in accounting language. That is because in some ways it is. But here is the shift that makes it manageable. You do not read a 10K the way you read a book, front to back, every page with equal attention. You read it like a detective. You know what you were looking for, and you go straight to the evidence. The 5 sections that matter most to investors are: business description. What is this company, really? Risk factors. What could destroy the thesis? MD&A. Management's discussion and analysis. Why did the numbers change? Financial statements. What actually happened? Notes to the financial statements. What is hiding behind the headline numbers? Each section answers a different investor question. Once you know that, the document stops being a wall of text and becomes something closer to a structured interview, where the company is answering your specific questions, whether it wants to or not. Let's go through each one. This is the section most investors skim over to get to the numbers. That is a mistake. The business description is where you answer the most important question in investing. Do I actually understand how this company makes money? Not at a surface level. Not they sell software or they make chips. Really understand. Is the revenue recurring, like Adobe's subscription model, or cyclical, like a semiconductor company tied to smartphone upgrade cycles? Is the company dependent on a handful of large customers? Qualcomm, for instance, historically derived a massive portion of its revenue from Apple. That is not a footnote. That is a business risk embedded in the revenue model. Does the company operate in one geography or many? International exposure introduces currency risk, regulatory risk, and geopolitical risk that a domestic business does not carry. Does it operate as one unified business or multiple segments? Amazon's business description reveals 3 distinct economic engines: a retail segment with thin margins, a services segment, Prime, advertising, with better economics, and AWS, which is operated at margins that would make most tech companies envious. If you look at Amazon as a single monolith, you miss the whole story. This section also tells you about the competitive environment. Who are the major competitors? Is the market consolidated or fragmented? Does the company have long-term contracts, or is every sale a new fight? The investor's test is simple. After reading this section, can you explain in 2 sentences how this company makes money and why customers keep coming back? If you cannot, do not move to the numbers yet. Numbers without business understanding are just noise. The risk factors section is where most casual investors stop reading after the 2nd page, because it sounds like every company listing every conceivable catastrophe in legal language. And that instinct to skip it is exactly what separates the careful investor from the careless one. Yes, companies include generic risks to protect themselves legally. Boilerplate language about macroeconomic conditions and interest rates and cybersecurity appears in almost every filing. But embedded within that generic language, are often very specific, very material risks that directly affect whether your investment thesis holds. Here is how to read this section like a professional. Do not try to absorb every risk. Instead, bring your thesis into the section and stress test it. For example, if you are bullish on a company because of a blockbuster drug, the risk factors will tell you when the patent expires, whether there are legal challenges to that patent, and what the regulatory approval timeline looks like. That is not boilerplate. That is the clock on your thesis. If you are investing in a company because of its dominant customer relationship, the risk factors may reveal that the contract with that customer is up for renewal next year, or that the customer recently developed an in-house alternative. Netflix for years carried risk around content licensing. The studios it depended on were also its potential competitors. If you are investing in a high-growth tech company with significant debt, the risk factors will tell you when that debt matures and what conditions trigger covenants. In a rising rate environment, that section tells you whether the company has room to breathe. The practical exercise here is this. Write down your 3 or 4 core reasons for believing in the investment. Then go through the risk factors asking, one by one, is there anything here that would make this assumption wrong? That is not pessimism. That is intellectual honesty. And it is the difference between an investor and a storyteller. If the financial statements are the what, the MD&A is the why. This is the section where management explains the results in plain language, and it is one of the most valuable sections in the entire document, for a reason most investors overlook. The income statement might show revenue grew 14%, but MD&A tells you why. Was it volume growth? More units sold? That is sustainable and tells you the product is winning. Was it pricing? The same customers paying more? That tells you about pricing power, which is one of the most valuable characteristics a business can have. Was it an acquisition? That tells you growth may not be organic and requires you to assess what was paid and what was acquired. Was it foreign exchange tailwinds? That tells you the reported number may look different when those tailwinds reverse. Was it a one-time contract? Then do not annualize it. Similarly, if operating margins compressed, MD&A tells you whether it was because of temporary investments in growth, which can be positive, or because of structural cost pressure and weakening competitive position, which is a very different story. Apple's MD&A in various years has been explicit about which product categories are driving growth, which geographies are accelerating, and what is driving services revenue relative to hardware. That granularity lets you separate the durable growth from the cyclical. The questions you are asking throughout MD&A are, why did revenue change? Why did margins change? Why did cash flow change? And then the meta question, is management being clear and direct, or are they being vague where you need specifics? Good management teams tend to explain results clearly, acknowledge problems honestly, and give you the information you need to track the thesis. Weak communication is not always a red flag, but if management consistently buries bad news in euphemisms and avoids direct answers to analyst questions, that pattern tells you something. Now we arrive at the financial statements. 3 documents. 3 different lenses on the same business. The income statement answers, is the company profitable? The balance sheet answers, is the company financially strong? The cash flow statement answers, does the company turn accounting profits into real cash? A critical error that many beginners make is anchoring entirely on one number, usually EPS or revenue growth, and treating it as the whole picture. But a company can show strong EPS while its free cash flow is deteriorating. It can grow revenue while destroying margins. It can report record profits while its balance sheet quietly accumulates risk. WeWork, famously, reported extraordinary revenue growth for years. The cash flow statement showed something else entirely. The goal is to read all three statements as a system, triangulating between them to build a coherent picture of what is actually happening economically. Let's go through each one. 3 documents, 3 questions. You need all of them. The income statement asks, is this business profitable? And is it becoming more so? Gross margin is where to start. Microsoft runs above 70%. Software has near zero incremental cost per new customer. A grocery retailer sits around 22%. Tight margins, volume-driven, execution is everything. Neither is automatically better, but gross margin immediately tells you what kind of business you are dealing with. Then look for operating leverage. Revenue growing 15% while operating income grows 25% means fixed costs are being spread across a larger base. That gap, revenues scaling faster than expenses, is one of the most valuable dynamics in investing. And treat EPS with appropriate skepticism. Buybacks, one-time tax events, and accounting decisions can all make EPS grow even when the underlying business has not improved. The balance sheet asks, can this company survive difficulty? Focus on 2 numbers, cash, because it buys options, and net debt, total debt minus cash, because it defines how much pressure the business can absorb. More important than the total, check when the debt matures. Obligations due in 5 years mean flexibility. Obligations due in 18 months may mean a refinancing problem that does not appear on the income statement until it suddenly does. The cash flow statement asks, are the profits real? Accounting records revenue when it is earned, not when cash arrives. Free cash flow, operating cash flow minus capital expenditures, is where that gap closes, and it is the closest number we have to what the business is actually generating. Capital intensity shapes this dramatically. A railroad spends billions continuously just maintaining its track. Airbnb owns no physical assets. That structural difference is a significant reason asset-light businesses command valuation premiums. One nuance worth knowing. Stock-based compensation gets added back in FCF calculations, but SBC dilutes shareholders. It is a real cost. A company reporting $2 billion in free cash flow while issuing $1.5 billion in stock compensation is generating considerably less value than the headline suggests. The notes to the financial statements are where most investors stop reading, and where patient investors often find what everyone else missed. 4 footnotes consistently matter. Segment reporting, which can reveal that one division is carrying the whole business while another quietly declines. Revenue recognition, which in software and subscriptions shows whether growth is durable or front-loaded. Stock-based compensation, which gives you the exact annual dilution to your ownership stake. And the debt maturity schedule, which tells you not just how much is owed, but when, and at what rate. The footnotes take time. That is exactly why most people skip them. And that is exactly where the edge lives. 7 questions. Use them every time. 1. Can I explain this business model in 2 sentences? 2. Is revenue growth driven by volume, pricing, or something temporary? 3. Are gross margins stable and is operating leverage visible? 4. Does net income convert into real free cash flow? 5. Is the balance sheet strong enough to survive 2 difficult years? 6. Is the share count rising or falling? And 7. What assumptions does my thesis depend on, and where in the risk factors do they get challenged? That last question matters most. Investing is not about finding perfect companies. There are none. It is about identifying the gap between business reality and market expectations. A stock down 20% can still be expensive. A business no one is excited about can be the opportunity of a decade. The 10K is where you build your own answer, independent of what the market has already decided. Stop asking, is the stock going up? Start asking, what has to be true for this business to be worth significantly more in 5 years? The first question is unanswerable. The second is the right work. The stock chart is the surface. The annual report is the X-ray. In investing, you want to see what is actually inside.